Welcome, everyone. So glad you could join us just a few days before Christmas. I guess that means if you're here, you've already finished all of your shopping and your cooking and you're fully prepared. I'm Kathy Fettke, co-founder of RealWealth, and excited to be doing this year-end housing market review with our very special guest, Rick Sharga, EVP of Market Intelligence. So just that alone tells you it's going to be a very smart webinar. Right, Rick?
It's the first time in my career anybody has used the word intelligence in the same sentence with my name. So it's a watershed moment for me.
Oh, so glad I could give you that holiday gift. But yeah, you come armed with data from ATTOM. You guys, I don't know, maybe you can explain where you get your data, but all I know is you come with it, and it's going to be very enlightening for a lot of people who maybe just see the headlines or talk to their neighbor and they're surrounded by fear and maybe accidentally went on YouTube and watched the sky is falling video. So where do you get your data?
Yeah, actually, we have a couple slides on that, but we collect public record data on all 150 million or so residential and commercial properties across the country. So transaction history, property characteristics, ownership information, transactions, loans, pretty much you name it. If it's related to the property, we collect it, both recorder data and tax assessor data. And then we append it with things like foreclosure records, environmental and climate change risk, noise, just so pretty much anything you're interested in that's related to real estate data we have available, and we license it in bulk to bigger companies, and we make it available in individual property reports and marketing lists for individuals. So it's a pretty comprehensive suite of services.
Well, and data is just a bunch of numbers unless you can interpret what it means. And I think that you really have that gift of being able to boil it down to what does this mean to us as investors and what do we do with it? Kind of looking at the year and getting sort of the truth of what happened this year and what that means to us and how we go into the next year. So with this, I'm going to hand it over to you. I made my job easy by having you do the work, and so thank you. But I know you're going to pause between slides, and I'll be taking some questions as we go along, and then of course there'll be time for questions at the end. So quick disclaimer, we always have the disclaimer, so you've probably seen this a million times, but just want to make sure that you know that this isn't investing advice. We're giving data and opinion. So always do your own due diligence when it comes to investing in certain areas or in certain properties. That means looking up your own market data or going to ATTOM Data Solutions and getting those reports, getting the appraisals and inspections. Okay, and I just want to let you know about some upcoming events for the new year. Can you believe it? The new year 2023. Let's see, so we've got on the January 5th, my hubby will be doing his Focused Investor program that is probably one of the most popular every year. It is a wonderful way to get very focused for the coming year and make sure you're ready for it and prepared for it, and that it's your best year yet. So you don't want to miss that, January 5th. Then the week after, I'll be doing my housing market predictions, which will take a lot of what we talk about today and sort of look forward at the coming year of what to make of it. And then we were talking about doing a live event, and we decided to do a live virtual event. This way we could have more people join us. RealWealth has grown to a point where we have people all over the country and all over the world, and so this will be a virtual event. But I promise we will be doing an in-person event at some point. But this way you can learn while sitting in the comfort of your living room. That'll be Saturday, February 11th. We're going to have a lot of the different providers from around the country come on and talk about what's happening in their market and what their strategies are and why they're actually very excited about 2023 and the opportunities it presents. We'll meet with different providers who are actually buying down interest rates for us. The builders are needing to move inventory and willing to pay down your mortgage to really attractive interest rate with lower prices. So lots of incredible opportunity out there, and we'll be doing that on the 11th, plus education and opportunities available. Okay.
What a
And then also,
great early Valentine's Day date as well. I mean, just can you think of anything more romantic than learning how to invest in real estate?
yep, get your champagne and sit down and by the fire and listen to some real estate. And then also Rich and I are doing our first mastermind sort of real wealth retreat at our home in Malibu. It's going to be limited to just 12 people, but we're going to take the exercises that he does on that focused investor and really go deep, help you really plan out 2023, leave with a binder and a plan, and also have a lot of fun. You can find out more about that retreat at kathyfettke.com. It's my new website, kathyfettke.com. Just go on the mastermind page. Okay, so Rick, I've known Rick for so many years. We've done many, I don't know if you want to go back to that slide, Rick, but
Oh, sure.
we've done a lot of actual media. We've been on media interviews together. I think we were in Bloomberg together once. That was always really intimidating because I knew you had access to more real-time data than me, but that was fun. You're the Executive Vice President of Market Intelligence, as I already said, at ATTOM, which is one of the country's leading providers of real estate data, as he mentioned earlier. He's been on so many media outlets like you see here, CNBC, CBS, NBC, CNN. So it's just really an honor to have you here and get a whole hour. Wonderful. So, and then you're founder of CJ Patrick Company, consulting firm that helps real estate, financial services, and tech companies develop a position of competitive advantage to drive business strategy, marketing, and sales.
Yeah, that reminds me of me. We're going to go through a ton of content, and I apologize if we go through it really quickly. But for anybody who's viewing today, anybody who's joined us, there's going to be a PDF of the slides available as a handout after the session. What I planned to cover was a little bit about ATTOM, just for people who didn't know. Kathy was nice enough to have that discussion earlier, so we're going to kind of skip over that pretty quickly. But we're going to spend a chunk of time on what's happening in the economy, because that really drives what's going on in the real estate marketplace. It certainly drove what happened in 2022, and will have a hangover effect on 2023. We'll take a look at the housing market. We'll take a look at foreclosures, because I know a lot of real estate investors are interested in purchasing foreclosure properties, and we'll do a little bit of an outlook into 2023 without stealing too much of Kathy's thunder. Just give you some kind of 20,000-foot views on what is to come. I mentioned that ATTOM has a lot of data. We break it up into a table of data elements just to give people PTSD from grade school when they had to memorize the atomic chart. But we break it up into different categories. So whether you're looking for property data or mortgage transactions or parcel boundaries or whatever, you can find it fairly easily. And I think I mentioned earlier, we make it available in bulk licensing or individual products. But again, not going to spend much time on that because we already talked about it. Let's talk about the economy. As you're viewing this today, the stock market is taking a beating. And is taking a beating because the revised estimates for the third quarter GDP came in higher. So we're living in an opposite world where good GDP numbers are actually bad news from the market's perspective. But the bottom line with the GDP, the gross domestic product, which is the baseline metric that most economists use to figure out what's happening in the economy, is that after two consecutive negative quarters in the first and second quarter of this year, the third quarter came back into positive territory. Technically, the definition of a recession is two consecutive quarters of negative GDP growth. So for the pessimists out there, you can say that we were technically in a recession for those quarters, but realistically, it didn't feel like we were actually in a recession. The other metrics you would take a look at, whether it's productivity, trade rates, the strength of the dollar, and some of the other criteria that we're going to cover in subsequent slides, were all very strong and continue to be strong. So really didn't feel like much of a recession if we were in one, but the projections for next year are somewhat less optimistic, and we'll get into what's likely to happen in a few minutes.
And Rick, can you just explain really quickly why the stock market would react negatively to a positive GDP report?
It all comes down to inflation and the Federal Reserve's activities to try and get inflation under control. So right now, what is normally good news in the market, whether it's strong GDP, whether it's good employment numbers, those things that normally are regarded as very positive suggest that the economy is continuing to be too hot and that inflation will continue to be too high. And so, like I said, we're living an opposite world where strong GDP numbers are viewed as a negative thing because it suggests the Federal Reserve will have to be aggressive in raising the Fed funds rate in order to get inflation under control. And that has a whole series of ripple effects throughout the rest of the economy. So it's a strange time in the markets, to say the least. And today's market on the 22nd of December basically wiped out a 500, 600 point gain on the Dow from yesterday. So it's been a roller coaster ride watching the stock market recently. I mentioned the other metrics are all very strong. This is one that we all watch very closely. It's the unemployment rates. The blue bars here are the long-term unemployment rates. They're unemployment rates, and the dotted line is continuing jobless claims. And you can see that unemployment overall has gone back to where we were prior to the pandemic. We had one of the most unusual unemployment periods in the history of the country during the pandemic. We lost 22 million jobs virtually overnight when the government shut down everything. And what's been really unusual about this spike in recovery is that, one, the spike was caused primarily by job losses in one segment of the economy. It was the service sector, so restaurants, retail, travel, tourism, hospitality, entertainment, those kind of markets all took a real beating, and most of the job losses were there. The other thing that's been really unusual is how quickly the jobs came back. So if you go back to the Great Recession, unemployment peaked at about 11% compared to 15% this time, but it took us a whole decade to recover those jobs. In this case, it took us about 2 years. So just a remarkable, remarkable recovery. And the fact that most of the job losses were in the service sector is one of the reasons the housing market didn't take a beating during the pandemic. It turns out that most of the employees in those sectors are renters, not home buyers, not homeowners. And so the owner-occupied part of the market really kind of came through the pandemic not only unscathed, but healthier. So the unemployment numbers, as I said, have been very strong. You see on the right hand of the chart, the numbers are ticking up just a little bit. This is another one of those kind of misleading data points. The unemployment numbers came up a little bit because what they call the labor force participation rate, or the percentage of adults who are either working or looking for work, ticked up a little bit. So the fact that job unemployment numbers came up a little bit was actually, believe it or not, a good sign. It shows that more people are coming back into the jobs market. Jobs themselves, and you can quibble a little bit about this, and I know some people do on social media. We've seen job growth continue, we've seen wage growth continue. Some people will tell you that it's not really job growth, it's really filling the jobs that were lost during the pandemic. It's still new hires, so it's been very strong. Again, this is one of those things that the Federal Reserve is looking at and actually kind of hoping we see a little bit of weakness here. Not necessarily negative job growth, but not quite as strong job growth, because job growth in today's economy actually contributes to wage growth, and wage growth contributes to inflation. So it's a really messy period of time. But wages have been growing at 5 or 6%, very strong. There are still about 10 million open jobs, and there's about 6 million people looking for work. So very unusual employment picture in U.S. history. You usually have more jobs available, or you usually have less jobs available than people looking, but this has been the case now for a couple of years. So that leads employers to pay more, which again is one of the reasons we're seeing wage growth as strong as it has been.
Rick, I'm going to jump in right here because I see in the forums, I know people on social media make lots of comments that maybe aren't grounded in data. But I'll often see, in this economy, it's such a bad economy. It's like, well, with 10 million job openings, how is that a bad economy? So if people are sitting on the couch, just let them know, no, we need you to get out and work. There are jobs. But when people say that, are they referring to a certain type of job? I mean, are there certain job openings that people can't qualify for, or like?
Yeah. So there's always been, and right now there clearly is a couple of disconnects. In some cases, the jobs are available in geographies where people don't live.
Mhm.
So you have people looking for work in one state and there's jobs available in another state. That's not going to be a big help for most prospective employees. In some cases, it's a skill set mismatch. You're looking for somebody to fill a particular type of job, and the people nearby don't have that skill set. Um, so those are two things. I get a lot of pushback, not a lot. I get occasional pushback from people saying, yeah, but these are all bad jobs that are available. These are all
Yeah,
those
I've heard that
low-paying
one too.
jobs.
Yeah.
And I can tell you from helping people kind of look for work and kind of going through the job sites, there's a lot of really good jobs out there.
Mhm.
This is not all entry level, all service industry kind of jobs. There's a lot of good jobs available. So no, I think a lot of the commentary we're seeing on social media is unfounded,
Mhm.
um, and I think we're at a period of as full employment as we'll probably ever be. Odds are very strong that, and we'll talk about this, if we get into a recession next year, we'll see unemployment tick up a little bit. But for the most part, there's a lot of jobs out there for anybody looking for work.
Okay.
65 to 70% of the GDP is made up of consumer spending. So this chart's kind of important. We're seeing consumer, and this chart's also very unusual. Another one of these aberrations that happened after the pandemic. Historically, the two things on this chart, consumer confidence and consumer spending, go hand in hand. So the
Mhm.
more confident consumers are, the more willing they are to spend. And that's especially true on large, long-term financial commitments. And you can see when the pandemic hit in 2020, we saw consumer confidence plummet. We saw consumer spending go down. There just wasn't a lot we could spend money on. But as we came out of the pandemic, consumer spending continued to go up, even as consumer confidence hit all-time lows in the University of Michigan survey that charts this. And consumer confidence is still relatively weak. It's ticking up a little bit, but it's still relatively weak for a number of reasons. Inflation is the number one cited reason right now, cost of living. Things like the war in Ukraine, things like ongoing COVID infections weigh into that as well. Some degree, people are a little concerned about political instability in the country, but the spending has continued to be very, very strong. There's a couple reasons for that. One is that we have a couple of years of pent up demand that's all hitting the books at the same time. There was just a period of time where you couldn't get what you wanted to get. And so people are now buying those things that they wanted a couple of years ago. The other is that, and you won't hear this out of Washington, but the government, frankly, just overstimulated the economy.
Mhm.
We increased the monetary supply by about 50%, which is really why inflation is as high as it is, in addition to things like the supply chain disruption that they always talk about. But everybody was getting stimulus checks. People were getting enhanced unemployment benefits. They were basically socking away that money, and now they're spending it. And that's one of the big drivers of inflation. So it'll be interesting if consumer confidence doesn't improve. It probably will mean that spending will revert to the mean, and we'll see spending come down. And we could theoretically worry ourselves into a recession just based on consumer spending coming back down to more normal levels. But two things to think about with this consumer spending that are kind of red flags. One is we've seen consumer credit use go up pretty significantly over the last couple of quarters. And the other is we've seen the savings rate drop down below pre-pandemic levels. So for a while during the pandemic, we had an all-time record high in the amount, the percentage of money that people were putting into their savings. That was, again, because the government stimulus was coming out at a time when there was nothing to spend money on. So people were saving it. Now we've reverted below what we saw prior to the pandemic to very low rates of savings and very high amount of credit card usage. The concern is that we might be seeing people having a hard time making ends meet because of the high cost of living, the high rate of inflation, and now they're tapping into their credit cards to make ends meet, or They're pulling things out of savings to make ends meet, and neither of those movies would have a particularly happy ending. So it's interesting that we haven't seen credit card delinquencies go up yet. In fact, the only credit area where we've seen delinquencies go up is in the automotive area, where there was an awful lot of subprime lending being done in the last couple of years. But it is something to watch as we go forward to see if households really are in financial distress or if they're just spending a lot of money right now. I mentioned inflation was still running high. We've had a couple of consecutive inflation reports, consumer price index reports that have been positive. We've seen inflation come down month to month and year over year, but we're still near a 40-year high in terms of the overall rate of inflation. And for households, at or below median wages, it's been a little bit more troubling because the inflation numbers we track don't really include things like food and energy costs, and we know both of those are much higher than they were a year ago. So it does at least, again, wave that cautionary flag that we have to keep an eye on this. But there is hope in the markets right now that if these inflation numbers continue to move in the right direction, the Federal Reserve will be able to get a little less aggressive about raising the Fed funds rate, and that'll let things like the mortgage market settle back down a little bit and stop being as frothy as it is right now. So I wanted to show everybody, because I think this chart really kind of puts into stark relief what we're seeing from the Federal Reserve right now. Yeah. The shaded area here shows the Fed raising the Fed funds rate. And the last time they did this, they did it in a very typical way. And you can see back in 2016, they raised the Fed funds rate about 0.5 point, and then they raise it another 0.5 point and 1/4 point. And typically that's what they do. They do it step by step, usually at 1/4 point or no more than 0.5 point increments, until they get to the level where they think inflation is under control. And then they drop back down. And when the pandemic hit, they went all the way back down to virtually zero at the Fed funds rate, to try and stimulate the economy through what they expected to be a worse economic downturn than we actually had. The overstimulus, the supply chain disruption, the war in Ukraine, all the things that we talked about drove inflation up to 40-year highs, and the Fed whiffed. And I'm not picking on them, they admitted they whiffed. They had first claimed that inflation was going to be transitory. It turned out that transitory has a much longer life expectancy than they thought it did. And then they also said they should have acted sooner than they did, because it's stickier and more severe than they anticipated. So the way they've responded to that is with unprecedented increases in such a short period of time. And you can see that spike on the right-hand side here. And that spike is what they felt was necessary to slow down demand, in turn slowing down the economy, and therefore bringing inflation under control. But Kathy, I know you've lived in cold weather areas. I'm originally from Pennsylvania. I learned to drive in ice and snow, and you learn quickly that there's a better way and a worse way to try and stop your car on a slick road. And the better way is you tap on the brakes quickly and gently and come to a controlled stop and pull off to the side of the road. The less good way is you slam on the brakes and skid into a ditch. And unfortunately, the Fed waited too long this time to use the better way to slow down. They've had to slam on the brakes. So the only question here isn't can we avoid the ditch, but is it going to be a deep ditch, and how long is it going to take us to get out of it? So I'm of the opinion that a recession is almost inevitable in 2023. And I look at two historical data points that kind of support this. One is, and I apologize if this is a little bit too much inside baseball, but it's called a yield curve inversion. Typically, if you look at a long-term investment and a short-term investment, the return, the yield on a long-term investment is going to be higher because there's more risk involved the longer your time horizon is for the investment. So economists will watch the yields on a 10-year bond versus a 2-year bond. And again, typically the yield on a 10-year is higher. When the yield curves invert, they change places. So the yields on a 2-year bond are higher than they are on the 10-year bond. We've been in that situation pretty significantly now for a few months. It is a very serious yield curve inversion. And the last 7 times we've had a yield curve inversion, it's been followed by a recession. So it doesn't cause a recession, but it's a very, very reliable predictor of one to come. And the market right now is pointing toward that happening. The other historical data point I would share with you, and this is a chart from the chief economist at Fannie Mae, not stealing anything proprietary here. This is all public record data that he was using. I just like the way he pointed it out. The last 11 times that the Federal Reserve has raised the Fed funds rate to get inflation under control, 8 of those times they've steered us into a recession. And that's typically because, those are all the red arrows here. That's typically because they either waited until inflation got too high, or they waited until it got kind of stuck in place and became sticky and hard to remove. And they've already admitted they came to the game too late this time. So again, if you look at history as a predictor, the only 3 times the Fed was able to steer us toward a soft landing was when they acted early. They didn't do that this time. So again, the 2 predictors that I look at in terms of whether or not we get a recession are the yield curve inversion and the Fed actions in terms of raising the Fed funds rate. Both of those really do kind of point toward a recession. If there's a silver lining in this cloud, it's that all of the other aspects of the economy continue to be very strong right now. And what that suggests is that even if the Fed does kind of inadvertently steer us into a recession, the likelihood is it should be a fairly mild and fairly short-lived recession, because it's not a recession we're entering into because the economy itself is particularly weak or troubled. So that's the hope. And most of the economists who I follow or speak with, or who I believe are credible, are predicting something along those lines, and they're predicting that unemployment does go up a bit, but probably not much higher than 5.5%. And if you look at unemployment historically, 5% is really kind of the point where we consider unemployment to still be pretty healthy. So, and my personal research suggests that it's getting to about 6% when it really does have a material effect on the housing market. So if we can really get by with a fairly mild recession, hopefully it doesn't do much damage to housing.
You know, normally when you're tasked with a job and you fail that many times, maybe you lose your job. hopefully they learn from this one.
You know,
but yeah, I mean, Rick, they were stimulating the economy until this year. I mean,
one of my favorite economists, and I don't know if he wants me quoting him, so I won't name him, but he had a great line. He said the government and the Federal Reserve took a $3 trillion hole and tried to stuff $15 trillion into it.
Yeah.
And the cynic in me says, you know, they probably got some votes out of that. But the bottom line is they created the inflation, and now they're having to overreact to get rid of the inflation. The earliest part of the pandemic, I really thought both the government and the Federal Reserve acted appropriately, because we didn't know how bad things were going to get. We threw the economy into full stop, and we needed something to protect households from deteriorating. But once we got out of that first wave, the follow-on activity was just way over the top. And then for the Federal Reserve to come out and say inflation was transitory and it was all caused by supply chain disruptions, like, but it's hard to fire a Fed chairman. They're kind of, you know, they're there, and they kind of don't answer to anybody on purpose. So it's because you don't want that to be a terribly political appointment. So
yeah, it's hard to fire the biggest banks in the banking system as well. So it's what we got, but you got to just know what's happening and work around it.
So the Fed actions have had a material impact on the housing market. If they haven't stated this, but if one of their major objectives was to slow down an overheated housing market, they have succeeded beyond their wildest dreams. And the way they did this was by really adding a huge dose of volatility to the mortgage market. So even though we've seen mortgage rates trickle down a little bit, we're still near a 20-year high in terms of the 30-year fixed rate loan, which is the primary lending tool that most people use. And according to Freddie Mac, this is the first time in history that mortgage rates have doubled in a calendar year. So the market simply hasn't had a chance to adjust. We recently released an affordability report that we do quarterly, and 99% of the markets we covered have affordability now that's worse than their historic averages. Really, anywhere you go across the country, affordability has taken a huge hit because of these interest rates doubling. And in fact, if you were looking to buy the same house today you were looking at a year ago, your monthly mortgage payment, depending on where you are in the country, would be anywhere from 45 to 60% higher than it was a year ago, strictly because of what's happened with mortgage rates. So normally mortgage rates trickle up or home prices trickle up and the market adjusts as needed. You have buyers who are looking at a $500,000 house looking now at a $450,000 house. When mortgage rates double, they have to stop looking at the $500,000 house and look at a $250,000 house. And that just hasn't been in the card. So we've seen home sales just plummet. And if I'd done this chart today instead of yesterday, Kathy, I would have had one more month to show you. And unfortunately, the trend would have been exactly the same. So November actually marks 14 consecutive months where we've had lower existing home sales. And what's really unusual is it's 11 months this year where the number of existing homes sold is lower than the month before. So it threw seasonality completely out the window. You usually have increased sales in the spring and summer, but that's when the mortgage rates went up. So we've seen those numbers come down month after month and on a year-over-year basis as well. We're going to end this year probably between 15 and 20% lower in terms of existing home sales than we were a year ago. 2021 was a strong year, but even allowing for that, a 15 to 20% drop is just pretty much unprecedented. We're having a similar drop in new home sales. These numbers have bounced around a little bit. We actually had 1 month this year that was stronger than the year before, but the net is we're still going to be off over 15% when this year is over, especially considering how strongly last year ended. You see more volatility in new home sales, and that's because if you're an existing homeowner sitting on a 2.5% mortgage and you don't have to sell your house today into a declining market and then take on a 6.5% mortgage, you're just going to stay put until market conditions improve. But if you're a new home builder, if you're Toll Brothers or Pulte Homes or somebody like that, and you have 5 properties at the end of a development that are sitting there vacant, they're costing you money every month. So you're going to be motivated to sell them. So whether it's buying down points on a mortgage, whether it's offering concessions, whether it's doing price discounts, we're seeing a lot of that happen in the new home market. And when you do see mortgage rates trickle down a little bit is when you see a little bit more buying activity in the new home sector. And I expect we'll continue to see prices decline a little bit in new home sales as we get into 2023, but that's not, don't misinterpret that. That doesn't mean you're getting a $500,000 house for $350,000. It means that the builders are shifting their tactics and they will build a $350,000 house instead of a $500,000 house. So the product mix will change a little bit next year to reflect the marketplace realities. Builders have also stopped building to a certain extent. After a decade of underbuilding, their sentiment index is dropping like a rocket. It's almost back down to the level it was during the peak of the pandemic. And as their sentiment has gone down, their housing start numbers have gone down. So this is one of those, you can look at it half full or half empty moments. The good news, I guess, is that because housing starts have dropped since mortgage rates went up, there's no danger of the builders overbuilding this time like they did in the last cycle. If you go back to 05, 06, they overbuilt. We had a 13-month supply of homes available for sale. No risk of that happening this time. But the bad news is we're not going to correct that supply and demand imbalance. It's been a problem for the last few years. But again, builders have slowed down pretty significantly. This is from our friend Mike Simonson at Altos Research, taking a look at inventory. Inventory numbers had been ticking up, not because there were new listings, or actually are fewer new listings, but because it was taking a little longer to sell the properties that are coming to market. But we're starting to see seasonality pop in now, and inventory is down to about 535,000 properties available for sale on the MLS this past week.
Wow, that's incredibly low. I thought it was higher than that. You're not just talking new homes; those are existing homes.
This is total inventory on the MLS.
Yeah, and
And
so I do
yeah,
want to say, like, on all the things that you were just talking about, there are different ways to interpret it. So when you
mhm,
see that sales are way down, who does that affect? A seller, right? It's affecting realtors, mortgage brokers. That's why you're seeing layoffs with those companies. Who is it good for? Well, the buyer, right? Because
well,
sometimes, I mean, unless you've got to
it,
pay that nasty mortgage.
well, it is good for buyers. Prices, and we'll get into this in a second, prices have been trickling down a little bit, but um, forgetting about the mortgage cost for a minute, you're right, that's a real burden for the buyers. There's just not a lot to buy. But this time of year typically is the best time of year to be looking for a house in most markets because there's less competition from other buyers. Um, and because sellers, knowing that, are a little bit more willing to negotiate. So if you can find a property you're interested in, and typically for most of your clientele, Kathy, they're buy and hold investors, so looking at a longer time horizon. This is one of those markets where theoretically, if you can find something you can afford and you like, it's a good time to buy. And the likelihood is a year or two from now, you'll be able to refinance that purchase into a lower mortgage. So your monthly costs can go down a little bit. But this is just
Yeah.
another way of looking at it. You can see that that new inventory is off by 28% year over year. So even when we were seeing inventory levels look like they were popping up a little bit, it was simply because the listings that were out there were taking longer to sell.
Again, that is just fascinating when so many people again online are like, ah, housing crash. Like where? There's no
Yeah.
inventory. But I really want to emphasize what you just said, that the same house that a year ago people would have been clamoring over and 100 people in line trying to get, you can get now for
Yep.
less.
Yep.
And the seller is willing to buy down your rate, so you're maybe even paying a lower interest rate. So if
Yep.
you can get past the fear of the headlines and just go, well, why would I have bought it last year for more about the same interest rate, but I'm scared to do it today when in fact there's very little inventory, and because of all this, massive demand for the rental property, because the person who would have been able to buy that property last year is now going to be renting that property this year. So
Yep.
from a, again, taking all this data and saying, well, what does it mean to me? It means that the rental demand's even stronger, yet you can get a better deal than you could have last year. So I just want to make sure that that message is out there.
Yeah, and home prices, the median home price has come down for several months consecutively. We're still a little above water on a year over year basis. So, but the difference is if you go back to January, February this year, on an annual basis, year over year basis, home prices were going up 15 to 20%. Now, if you're looking at annual price gains this month compared to the same month a year ago, you're maybe looking at a 2 or 3% price increase. And again, remember I was talking about wage growth. Wages are growing at 5 to 6% a year. So, this is one of those times that doesn't happen very often when wage growth is accelerating faster than home price appreciation. So there are opportunities out there, and people shouldn't ignore those by any stretch. We'll still probably end up this year with home prices at the end of the year being somewhere between 8 and 9% higher than they were a year ago. But that's a huge drop off compared to where we were, in 2021, when at the end of the year prices were up, I think 17 or 18% from the prior year. This is, again from Altos, they're projecting that we might see inventory levels climb back to 2019 numbers by the end of 2023, and that's partly with the notion that we'll see a little bit more building, a few more existing homes come to market, and again, the time to sell these properties take longer. And this goes to your point, Kathy, about fewer people clamoring to buy those properties. We're looking at the next two charts. We're looking at pending home sales, which you have a pending home sale, which means somebody's entering into a contract. So that home sale is going to close in the next month or two. So this is kind of a predictor of what we're going to see in the next couple of months. And I mentioned that we're going to end the year 15 to 20% down on a year over year basis for home sales. If you look at the most recent months, the numbers are much deeper drops. And according to Altos, looking at the most recent months, you're going to be looking at something like a 35% decline year over year for say January or February. The other thing we look at is purchase loan applications. So this is from the Mortgage Bankers Association, and looks at the number of people applying for a loan to buy a house. And this is what you were talking about, Kathy, with the mortgage industry really hurting. The most recent weeks from the Mortgage Bankers Association, 41% decline in purchase loan applications. So demand is clearly weakening from a buyer perspective. Due to affordability, and depending on whose research you look at, there's surveys out there that suggest somewhere between 10 and 20% of the people who were planning to buy have voted themselves off the island and are now planning to rent for the foreseeable future. And if you're an investor who owns single-family residential properties, I think this might be a short-term windfall opportunity, because if somebody was looking to buy a house, it might stand to reason they'd prefer to rent one than to rent another apartment. But if they're not going to be able to buy for a while, they're going to need to live somewhere, and I think some of these people will wind up renting houses over the next couple of years. The other part of the mortgage industry that suffered isn't on this chart. If I were to show you the chart of refinance loan applications, it would be almost a straight line going down. Those numbers are off by 86% year over year, because it doesn't pay you much good to refinance a loan at 3%. Into a loan at 6.5%. So that part of the business is just completely dried up. And so if you're looking at markets, despite the low unemployment numbers, the mortgage industry has had thousands and thousands of layoffs, probably not over yet. The real estate industry has had a lot of layoffs because purchase activity is down significantly. You've had some of the iBuyers laying off people because they underestimated the impact things were going to have in the marketplace and have been suffering ginormous losses. And the technology industry has had a lot of layoffs because some of the funding has dried up, and that certainly affected technology companies that impact the mortgage industry and the real estate industry as well. So these things are all interrelated, and it hasn't been a pleasant picture. One of the things I mentioned is that prices have been going down. Again, thanks to Altos for this number, but they track the number of list price reductions on properties listed for sale on the MLS. In a normal year, any point in time, you might be looking at 30 to 33% of properties having a price reduction on their listing. It's peaked at 42% this year, but it has peaked and is on its way back down, which suggests to me anyway that people that are now bringing their properties to market are bringing them to market with more realistic price expectations. And earlier in the year, they kind of got caught trying to sell the property for what it would have sold prior to mortgage rates going up. This is from Freddie Mac. They've also been charting where prices are declining, and that's the red and orange areas. And I'm sharing this because I think it's important for people to realize we're not talking about a national housing price crash. Sales are down, prices overall have more plateaued than crashed, but it's going to be a very localized correction. So we've been speculating that we'd see nationally prices go down about 5%. And I guess Fannie Mae is projecting about 1.5%. NAR is projecting flat prices, but it's going to be a very localized correction. So if you're on coastal California, if you're in the Pacific Northwest, if you're in some of the so-called Zoom towns like Boise, Idaho, Las Vegas, Phoenix, St. George's, Utah, where prices were up 50% over the last couple of years, you're probably going to see those prices come back down more significantly. Would not be a surprise to see California prices decline by 10%. On the other hand, if you're looking at the southeastern states, if you're looking at the Carolinas, Tennessee, Florida, most of Georgia, you can see the prices are still going up. And so anywhere where you continue to see population growth and job growth, you're likely to see the housing market continue to be healthier from a pricing standpoint. And I think this is what we're likely to see next year. Whether you like Zillow numbers or not, I just showing that there's multiple sources looking at very similar projections, and they have very similar projections in terms of 2023 pricing. And again, coastal California, some of the high-flying areas from the past couple of years, but strength in the Southeast. So you need to know your local market conditions. And when I say your local market, if you're an out-of-state investor, you have to know what's going on in the areas where you're investing. And again, the two factors I look at there primarily are population growth and job growth. You can also look at home sales and see if they're healthier than some other areas, excuse me. But it really is important not to look at the headlines, not to hear about housing crashes, not to be expecting that big wave of foreclosures. We'll talk about that in a second. There is going to be a market correction, but it's going to be very different depending on where you are, different parts of the country. And even with prices going down a little bit, there's a record amount of homeowner equity, $29 trillion according to Freddie Mac. According to our equity report at ATTOM, almost 50% of people with a mortgage are what we call equity rich, which means that they owe less than 50% of the value of their house on all of their loans. So you have a $400,000 house, you owe less than $200,000 on that. We've never seen numbers like that before. And this equity is one of the reasons we don't expect to see a huge surge of foreclosures, even as prices go down a little bit or the housing market struggles a little bit. Having equity gives homeowners in financial distress some options and the opportunity for a soft landing. We're already seeing that in the foreclosure numbers. And by the way, about 93% of borrowers in foreclosure have positive equity in their property, which is completely different than anything we've seen in prior cycles. And that's a segue into foreclosures. But for any of you worried about a foreclosure tsunami, we don't see one on the horizon, despite again what you're seeing on the breathless salespeople on YouTube. Anybody who's selling you a market crash right now is trying to sell you something, probably something expensive and probably something you don't want to buy. Delinquency numbers. I'm sorry, Kathy, go ahead.
Crypto, maybe?
We don't want to get there. And by the way, if you tank a multi-billion-dollar crypto company, as long as you have $250 million to post for bail, you can go live with your parents. We found that out today too. Mortgage delinquencies, which are a predictor of foreclosures, are now at lower levels than we had prior to the pandemic, and are actually at lower levels than we've seen normally historically. So in a normal market, about 4% of loans are delinquent and 1% are in foreclosure. Today, we're at about 3.6% that are delinquent, and about 0.5% are in foreclosure. So our numbers are lower than normal. We saw a spike during the pandemic, and it was because the government had a mortgage forbearance program in place that allowed people to miss mortgage payments as long as they worked out with their servicer the notion that their income had been affected by COVID. And we saw delinquency numbers go through the roof, and that was simply because everybody who was in the forbearance program was counted in these numbers as delinquent, even though they weren't reported to the credit bureaus as being delinquent, by the way. As the 8.3 million people who participated in forbearance have exited, less than 0.5% of them have defaulted on their loans. And in fact, 80% of the people who left with some sort of loan modification program in place have continued to make on-time payments since June of 2020. So a remarkably successful program. And anybody who was telling you that anybody in forbearance was going to go into foreclosure has missed the mark entirely. You will hear people tell you that there are several 100,000 people who have exited forbearance, don't have a plan in place with their servicer, and are delinquent, and that's actually correct. But what I would tell you is that in a normal market with 55 million active mortgages and normally 4% of them being delinquent, you would have several 100,000 people who fit into that category anyway. And a lot of these people were already delinquent before the pandemic. So these are the first people that wind up going back into delinquency and going back into foreclosures.
Can I jump in and say,
yeah.
There's companies like, I'll just say Black Knight, I think it was, who came out and said there'd be like 5 million foreclosures because of all those delinquencies. When a big company like that, am I right? Was it them that? Horrific.
I honestly don't know. I
Okay.
know there have been a couple people that have predicted huge
Yeah.
numbers. Yeah.
I mean, it's it was terrifying, and so for the average person saying, wait, they're a data company. I mean, it seems sure maybe people didn't know at the time that these people would be able to get out of forbearance. But when somebody sees that kind of headline, of course, that's what people hear, and they think that there's going to be this massive foreclosure. So, how do you know who to listen to?
Listen to me. No,
Okay,
just
listen
kidding.
to Rick.
Yeah, no, look, there are, so I honestly, and yeah, I am tooting my own horn here a little bit, but I put out a report when the pandemic was first declared. I went out, did research on how the economy and the housing market had fared during prior pandemics and periods of economic shocks like 9/11, where we shut the economy down for a little bit too. And interestingly, the economy and the housing market have always recovered very well from those pandemics. Housing even better than the economy. So I came out of that research feeling pretty confident that unless this pandemic was longer and more devastating than we even thought it was going to be, that the market would recover. Um, and it has. And the other thing that nobody knew what was going to happen with the forbearance program. The government simultaneously put a foreclosure moratorium in place. So, I mean, virtually nobody was getting foreclosed on for 2 years, other than commercial loans or loans that were on vacant and abandoned properties. So, unprecedented actions to try and prevent unnecessary foreclosures. But there was an economist based in New York City. I won't tell you who he was. I like following him because he's usually wrong. And he predicted that 35% of all mortgages would wind up in forbearance and that most of them would fail.
Yeah.
And if he was right about that, the servicing industry would have gone bankrupt, the mortgage servicing industry, and nobody would have been able to get a loan. So the percentage of loans in forbearance peaked right after the program started at about 8%. So about 4 million people in forbearance, and has gone down ever since. And I don't know if anybody really knew how successful this program was going to be, but when you give people 2 years to get back up on their feet financially, when you take all the payments they missed and tack it on to the end of their loan, so they're not responsible for paying those missed payments for 25 or 30 years, it helps. And we've had just a remarkably successful run of this. So whichever companies were making those projections probably jumped the gun a little bit and didn't really know what to expect. And just looking at that performance month over month gave us a lot of confidence that we just weren't going to see the kind of full-scale distress and default activity that some people were projecting. And keep in mind that loan quality entering the pandemic was already extraordinarily strong. So we got through the Great Recession. The CFPB and the government put new rules in place for lending, made it harder to get a loan, but meant that everybody who got a loan was really pretty well qualified. And these are people who tend to be able to recover faster if they do find themselves in financial distress. So even if you go back to 2019, foreclosure activity was running below normal levels. And where we are today in terms of foreclosure starts, you can see from the chart here, we're back to about 80% of the level we were in 2019. And that's on foreclosure starts. What's fascinating to me, Kathy, is if you look at the subsequent stages of foreclosures, if you look at the properties that are then referred to sale, getting ready to go to auction, that number is down pretty significantly. That's running at about 50% of pre-pandemic levels. About 60 to 70% of the properties getting to auction are selling to third-party investors at those auctions. That's twice the normal amount that's sold at auctions. So what's going back to the banks as repossessions is running at much lower levels. It's almost negligible. And these are repossession numbers at the foreclosure completions. So what that says to me is that more people are tapping into their equity to sell their property prior to the foreclosure auction. The properties getting to the auction are more successfully being sold to investors who are gobbling them up. And if you're waiting for REOs, if you're waiting for bank repossessions to be the kind of properties you buy as investments, there's not going to be many to buy. You're going to be looking for literally needles in a haystack because there's just not a lot of that activity going on. So that's one of the big differences in this cycle when it comes to distressed properties compared to prior cycles. And we're probably not going to be back to 2019 levels, which again were relatively low, until mid to late 2023. So what could throw these numbers off a little bit is if we do wind up having a recession that is a little more severe, a little deeper than what we're projecting. But again, if we wind up going to 5% unemployment, you might see foreclosure numbers come up a little bit, but nowhere near where we were back during the Great Recession. So quick recap of what we covered today. Very likely we're going to see a recession next year. It could start as early as the first quarter, but should be relatively short and mild. Mortgage rates, I believe, hopefully, have peaked for this cycle. I'm one of the few people actually saying that out loud, and I could wind up with egg on my face, but I believe if inflation numbers keep going the direction they're going, the Fed will take its foot off the brake a little bit and allow mortgages to kind of settle down. Loan volumes, if you're in the mortgage space, your loan volume is going to decline until at least 2024. But I do believe by the end of next year, we see mortgage rates back in the 5s, which I think will make people feel like it's more affordable. Home prices are likely to decline slightly on a national basis, but you're going to see very different results, local market to local market. We will probably see the number of home sales decline a little bit more next year. We don't think it's going to be a huge drop off from 2022, but maybe another somewhere between 5 and 10% overall. There is demographically driven demand that will provide a tailwind to the market. We still have the largest number of young adults who are entering prime age to form households. So they're going to be looking for rental households and owner-occupied households, but that number of people doesn't peak until 2024. So that's long-term good news for the market. Foreclosure activity is going to continue to climb back to normal levels slowly. May have a little bit of a spike depending on the nature of the recession. And this is important for your audience. Investors and cash buyers right now account for about 40% of all residential sales. Huge percentage. And we believe they will continue to be a high percentage as people who have to rely on financing kind of move back a little bit. If you're a cash buyer in today's market, you're in a huge position of competitive advantage. A year ago, you were competing with somebody who could get a 2.5% mortgage. That gave them a lot of flexibility and allowed them to compete with you even if you were paying cash. Now they're looking at 6.5% and 7%, and that gives you a huge advantage if you have cash you can leverage today. So just some things to think about as you're moving into the market. And again, for your audience, Kathy, buy and hold investors, I do think the rental market's going to remain strong, particularly in the single family rental side of the market for the next few years at least.
I could not agree more that, being a cash buyer, I don't know if you know, but we started a rental fund a couple months ago in North Texas, and we are often the only bidder. We have wholesalers coming to us, who normally, just didn't give us the time of day. So the deals are phenomenal, and the demand for those rentals is even stronger. And I agree with you on rates, that when they come down and with this low inventory we have, it's going to be another frenzy. In my opinion, whether it's going to be next year, middle of next year, or the year after, you have still the same dynamics in place. You've got young people forming families, the largest generation in history of millennials forming families and wanting probably a home for the children and pets. A lot of millennials are big pet owners. Right now they're renting, but once those rates come down, I don't know. So I know, again, it's always this fine line I walk, because I'll hear the little comments, oh, well, for a realtor, it's always a good time to buy, right? That is not, that I don't want people 5 months from now going, oh, now I'm paying more for the property because I have competition. When right now you can get it at a discount, and you can get into a shorter term loan. I mean, what are your thoughts on, say, a 5 or a 7 year ARM? I know some of the lenders that we're working with don't even have prepays. So as soon as rates go down, you can refi. But what are your thoughts about those arms?
Yeah, well, I watch out for prepays, and technically, the CFPB doesn't like prepays, so there shouldn't be many loans out there that have that in the documentation. I'm a big fan of ARMs. You have to understand there is a risk that at the end of your adjustment period, rates might have gone up, but typically that doesn't happen. Typically, especially when you're dealing with a market where rates have doubled in a year, seems less likely that you're going to wind up getting through that whole adjustment period and then wind up with a higher interest rate. But adjustable rate mortgages, if you're willing to take that risk, are a great way to, save a point or more on the interest rate that you're paying, and give you some flexibility in your financing.
Okay, well, we didn't surprisingly did not get a lot of questions. That's probably because you've answered what would have been a correct question, but there's one that I think a lot of people probably want to know the answer to, and I don't know if you can answer it, but with a recession likely coming, will it be felt broadly or hit certain industries harder than others? I mean, obviously real estate's kind of already in a recession.
Yeah, real estate and mortgage have already been hit, and a recession won't do either of those markets much good as well. If we have a recession, it's probably going to be a more traditional recession where you wind up with job losses across the board. And that historically has been the way most recessions have worked. You wind up with, professional managerial, manual labor and government jobs and everything else being hit. And it seems likely we would see a similar one this time. But the fact that we have three market segments right now that are already a little bit weak in mortgage, real estate, and technology, those are probably ones I'd watch a little bit more closely in terms of potentially more job losses than some of the other industries that are out there.
Yeah, and certain tech seems to be getting hit, certainly
Yeah.
crypto. All right, for short-term rental owners, what are good hedges for any economic headwinds? Boy, short-term rental, that's kind of a tough business right now, but thoughts on that?
God bless you. I don't have a hedge for you. The fact of the matter is, you're kind of at the mercy of the travel market. I was surprised short-term rentals came back as fast as they did after the first wave of COVID. I had actually forecast that market to really take a beating, more so than the hotel industry, because I thought travelers would have more faith in a brand like a Hyatt or a Marriott or a Hilton to have the kind of sanitation standards that you would want after a pandemic, and might not trust an individual investor who owned a rental property in an Airbnb or VRBO kind of environment. But exactly the opposite happened. We saw that part of the market come back more quickly. We're seeing that part of the market outside of resort areas start to struggle a little bit right now. So I think in a recession, having those kind of properties in a non-resort area might be an area of vulnerability. And I wish I had a good short-term hedge. I don't know, Kathy, if you have any ideas, but I honestly don't know what to tell you about those other than there's demand for houses. It might be, if worse comes to worse, it might not be the worst market in the world to try and move that property.
Yeah, I mean, I think you nailed it. It's if you compare to the last 2 years, I mean, you had people whose kids weren't in school, so they could travel, they could work remotely or didn't have to work at all and got a bunch of extra government money. We started our short-term rental over the past 2 years, and we're absolutely shocked at how booked we were at all times. But I wasn't relying on that money. It was just kind of like luck. But now it has slowed by 50%. I can't imagine if I had a massive mortgage, and bought it for that purpose. So, I have heard that medium-term rental is a good way to go because then you can get the traveling nurse. That might be one way to look at it. There's a book called 30-Day Stay. Maybe look in that, and it could be that the short-term or medium-term rentals near hospitals because of the traveling nurses could be an option. But I don't know. I would agree with you that if there's a way to put it on the market and sell it, given that there's such low inventory, that might be one way. What's a good way for solopreneurs to stay on top of economic conditions, present and future?
Well, watch Kathy's webinars and podcasts. She always has all the right folks on board. Risk of shameless self promotion. You can also check out ATTOM Data's website. That's ATTOM Data. We publish reports for free every week. No subscription, no money required. It's in the insights section on our website, and I'm always posting on social media, LinkedIn and Twitter. So, feel free to reach out to me as well if you like this kind of economic and real estate news. If you do want to connect with me on LinkedIn, make sure you mention that you're a friend of Kathy's, because I get a lot of unsolicited requests on LinkedIn that I'm pretty sure are bots from China, and I don't want to confuse you with one of them.
And you can see right here on somewhere on your control panel, Jill uploaded the handout, or Celia did, of this presentation. So if you want the slide deck, check your control panel. Rick, it's 1:06. Do you need to go? I know you have an interview. Okay. Yep.
I do actually, but I
Okay.
really thank you very much for having me today. I always enjoy our conversations, and looking forward to the next one. But happy holidays to you and Rich in the meanwhile.
Thank you so much. I'll stay on and answer some questions, but Rick, I know you got to go. Thank you so much for taking this hour to enlighten us.
Take care, Kathy.
Bye-bye. Oh, okay, so somebody said, not sure if it was covered, but where do you see mortgage rates? Yeah, that was Rick mentioned that. He sees them going down, so that's a good thing. I think he even said in the fives. What I know is that our investors are already getting rates in the fives because the sellers are buying down the rate. So don't let rates stop you from acquiring real estate today, because all the fundamentals are there with rental demand. And many of the markets we're in, you saw rent still going up. You're able to negotiate better prices than last year, get a decent rate. So just know that probably once rates do go down, it will be another buying frenzy, and it might be more difficult to get in at that time. Besides Florida and Texas, what are some of your favorite markets? Those are definitely my two favorite markets. As you know, I mentioned a rental fund in North Texas. You can go to growdevelopments.com to get details on that. GROW, growdevelopments.com. That's my syndication site. I think also if you just go to RealWealth, it can take you there too. There's still so much growth in Texas. It's unbelievable in this North Dallas area. When I was just there with a group of investors a few weeks ago, we were driving for miles and miles looking at freeway extensions and cranes and big buildings going up. I mean, it just has not slowed down, and yet we're getting properties at the 1% rule. And in this area where there's so much demand, we're renovating those homes to be attractive to professionals, because many of these people getting jobs there make a lot of money and they want a nice rental. So we're really turning them into A-class properties, and they're adorable. So anyway, you can check that out, growdevelopments.com. Of course, our teams in Texas and Florida are fantastic. Love those markets. We also, we still have great teams in Ohio and Indianapolis. There are some really great deals. We have a new market in San Antonio. I don't know if that's been presented yet, but that will be soon. That's exciting, but that's Texas, which is what you asked about already. But I would say if you haven't talked to your investment counselor, do so, because they're really more hands-on with the markets and the teams that we're in, because they talk to them regularly and they talk to our members regularly, who give them feedback on who they like and who they don't, and who's maybe superior than others. So definitely you'll get better information than me from our investment counselor. So if you haven't already spoken with your investment counselor, do so. If just they're really in the know. Okay, if you have a higher equity in your portfolio, how can you position yourself advantageously for the next 1 to 2 years? Either get a credit line or a refi to get some of that cash out. Being like Rick said, having cash right now is really powerful. But even just making an offer, there's a lot of sellers who'd be happy to wait 30 days for you to get your loan. So don't let that hold you back if you can't buy a property all cash. For North Texas market, do you see development happening north and west of Fort Worth? It's just all over. I think when I was there, who was I talking? Oh, at our event, there was somebody there who's doing some work in South Dallas, and I don't know anything about South Dallas because our team really focuses on North Dallas, but he said it was booming there too. So, you know, it's just booming. It's just booming. Following where the jobs are going is what we've done for years. So, you know, focus on that, where the job's going, because that's where people go and that's where you're going to have tenants and most likely demand for housing. I recently purchased a property in Texas, closed. Already have 100,000 in equity. Wow, good for you. How long do I have to wait to tap into that equity to purchase another rental? It just depends on the lender. Again, I would ask, we have a whole list on resources at realwealth.com of different lenders you can talk to about whether it makes sense to do a cash out refi or to get an equity line on that property. It's pretty hard right now to get an equity line on investment property. So I would, you know, I would definitely, I don't know if you're working with Leah in Texas, but I would talk to her. She seems to know a lot of local banks in the Dallas area that, you know her properties and know the area and are willing to do some pretty, you know, great lending there. Any suggestion on how to handle insurance Florida given the insurance crisis there? I think our insurance just went up on our Florida property too. I don't. I think that would make a great webinar on how to deal with insurance in Florida because, yeah, I mean, the way they're making up their losses is jacking up the insurance. We still love our property in Florida, but the cash flow is definitely hit by the increase in insurance. So I hope our team is listening and let's make sure we do a webinar on insurance. And I know being more inland and out of a flood zone is really helpful. Just, you know, it's going to be really expensive if you're near the ocean or in a flood zone. Okay, and I think also newer homes in Florida have a better insurance rate as well. The homes that we own are old, so I don't know if that has an impact, but from what I've heard, the newer homes have lower insurance rates. Okay, well, again, your investment counselor at RealWealth is, you know, all of our investment counselors are active investors. They're really in these markets. They can tell you firsthand what our members are saying and how their experience is in these different markets. So I would definitely tune in to our virtual event that's coming up because you'll get answers to a lot of questions. And then feel free to send them into your investment counsel. They're really quick at responding. Thank you so much for joining us here today at RealWealth, and I wish you a very, very, very happy holiday, a happy new year, and hopefully I'll see you in the new year. Take care.